financial markets, and my name is Anthony, your host. Now, on the 6th of October 2022, a Monetary Policy Committee statement was actually released by Bank of Uganda that indicated that the central bank rate had been increased by 1 percentage point from 9% to 10%. And the Bank of Uganda claims that there is a lot of global shocks that are affecting the economy currently, and inflation has not come down, with the consumer price index going up to 10% as well. Now today, joining me is a gentleman not very new on the show, Mr. Chimuni Musazi, who is from SBG Securities, and we are here to talk about the economy and investment options that we can take advantage of in such a beleaguered economy. Mr. Musazi, you're most welcome to the show.
Thank you, sir.
Don't you think, Mr. Musazi, the economy is too harsh for us to invest at this moment?
Usually, there will never be a time when everything is easy. Things have always been hard, but usually, as the saying goes, when the going gets tough, the tough get going. And I usually like to quote one of the ardent investors in the stock market and different investment options by the names of Warren Buffett. He always says the best time to make money is when there is blood on the streets. I've really tried to dissect that statement, and I would say usually the opportunities when the economy gets tough. For example, in the introduction you mentioned about the rising CBR rate from 9 to 10. That implies that other investors who have been in the market plus the borrowers will have to adjust their positions. Starting with the borrowers, what is the implication of this adjustment to a person who borrows money? You know, most of the businesses we run, 90% are financed by credit.
Yes.
By credit or loans, which they take from banks. So once the government adjusts CBR, in a way they look at options of curbing inflation. And being known that the government is the land of last resort, as I mentioned earlier, all banks run to the central bank to borrow. Which money they borrow as land of last resort also cascades down to the local borrower. It means if, say, Stanbic is to get any position from central bank at 10, they will have to adjust the lending rate, or what we call the prime rate. For the Muntua Wansi, maybe we would say the rate at which you will be borrowing from the bank. Yes, at times Stanbic is known for taking the shock. It doesn't adjust anyhow. At times even CBR is adjusted, but as the bank will take the shock because we have the interest and the feel of our clients at heart. But most of the local or small lenders who don't have a big book will definitely immediately adjust. If they adjust 10%, at times with them they tend to adjust twofolds. So the implication to the existing investor, one, the borrower, the rates are going to go up for most financial institutions. If you have been borrowing at 10%, or at 20%, it may go to 21 or 22, depending on each financial institution. So they will also adjust and pass on that cost to the final consumer. So basically, at times people ignore, or they may not know. Some ignore because they don't pay attention, but others don't even know what the adjustment in CBR means. And that's what brings us here, to try to break it down to someone down there. Maybe to bring it to local direct or to our lay person. Bw'owuliranga nga bagamba nti central bank erinyisizza rate from okuva ku 10 ku buli 100 rate kwewolera banks. Manya ne banks ezo zijja kipassinga on, oba zijja nazo kulinnyisa rate kwe zikuwolera amagoba g'osasula nga zikuwoze. Naye bwe weewola ate naawe bizinesi gy'okola ojja kwekanga naawe byokola olina okubyongezaamuko katono osobole okusigala ng'ofunako akatono ako. Ate naye mu kukirinyisa omuntu wa wansi ono abadde takifuddeeko naye awo ekimutuukirako nti abadde agula ekitole kya sabbuuni 1,000 ajja kukigula 1,100 naye ye kyekiva tamanyayo. Naye lwaki gavumenti yandirinyisizza rates oba gye tuyita CBR? Egezaako okukendeeza olumu wetulaba nga ebbeeyi y'ebintu edduka nnyo kye tuyita okulwanyisa inflation, erinnyisa rate eyo nti abantu abandi essente ziri mu saturation olumu zikendeerako nti abadde yeewola kubanga anyumira okwewola bw'alabawo omuziziko nga gugezzeeko gulinnyeemu ayinza okukendeeza nekikendeeza inflation nti essente mu saturation zikendeera nti adde yeewola buli kaseera ayinza okukendeezaamu. N'ekyokubiri nti bwe kigenda wansi ku final consumer oba oli agula ebintu naye abadde aspending adjustingamu kikendeeza ne ssente eziri mu saturation nti oba obadde osasula looni yo ng'osasula ebitundu 2 CBR n'erinnya wabaawo akawaayiro akatera okubeera mu ndagaano za bbanka nga bakuwola nti tunaakyusanga ebbeeyi oba rate kwe tukuwolera oba amagoba gozza okusinziira ku mbeera eneebaawo mu ggwanga oba okusinziira ku mbeera mu economy wetambula. Abasinga akantu ako batera obutakasoma. Nomugamba nti oyagala mmeka nti awanti 10 million nze kwewola million 10 njagala kukola kino nti rate onootwa 15 oba 17 nti kyabuuza nsayiningawa. Naye nga olwokuba nti omuntu waffe asemba wansi twagala tumunyonyo nti kabaamu ako naye rate eyo era bwekyuka tebazuka buzukusinga ffe ne tugikyusa. Bwekyuka eri waggulu naffe eno tujja ne tugamba nti ng'ennaku z'omwezi bwe ziti tuyinza okukyusa, tujja kukyusa ki rate kwe tukola kwe tuwolera okuva kweno okudda kweno. Ate ekyo kitwaliramu abapya n'ababaddewo nga balina loan. Abasinga most people akababuzaabuza prime rate bwekyuka eya bank oba rate kwe bawolera omuntu omupya ajja okufuna loan ajja kugira ku rate. Naye even the old person yabaddewo ng'alina loan adjustment eyo emukwatako era baziranga mu mawulire naye abamu bwe bakalaba bakayitako amala kulaba ng'eno ze basazeeko zeeyongeddemu n'amanya nti the impact has really touched me. But nandibuuzizza nti omuntu wa wansi how is it going to affect you but how are you also going to manage to answer the other question of yours. Ekisooka abadde yeewola okunyumirwa okyusa engeri gye weewolamu kubanga embeera eba ekyuse teba nnomo. Abadde aspendinga ebyokwejalabya okyusaamu no spendinga on only important things olira nti sisobola ku kyetuyita ekiteebereka nti it is inevitable kiweewolerako essebo.
It is a query on exactly what this rate usually does on the yields of the treasury bonds and bills. Yes, kugambye nti ababanjibwa bagenda kukisanga kizibu kubanga bagenda kuwongeza sente babadde bateekayo ng'amagoba naye tulina abantu babadde bagula bonds ne bills ate muneera wajja kusobola okukitangaaza bulungi ne rates zino especially on the primary rather secondary market the rates keep changing. Do we see a similar movement ngeri central bank rate eno gyetambulamu ne yields zino mwezitambula oba zitambula in an opposite direction?
Thank you, Sebo. Usually when we talk about the yields, these are returns on government papers. Or to make it a bit understandable, bonds and treasury bills. In the earlier show, I mentioned the difference between bonds and treasury bills, where bonds are more than any lending to government. Bonds and T-bills is where individuals are lending money to government. Of course, as you know, most of us in the African economies, we live on borrowed money. The government cannot raise enough revenue to run all its programs, so it comes to the market to borrow. But as I mentioned, the government does not show up as the executive. it does it through the its arm of the central bank. So when the central bank is coming in to borrow, it will issue treasury bills. Those are investments, or it is money you lend to government as an individual or as an entity for a period not exceeding 1 year. And bonds is where you lend to government. You as an individual can lend to government for a period of 1 year, above 1 year. We call it a bond. That's the only difference. But all in all, you are lending to government. So the impact of the lending, if the banks are raising their rates because the government has raised the CBR, or at the rate at which they will lend to, say, commercial banks. So even these individuals and individuals who are looking at financing or lending to government will look at the options and adjust definitely. They will say if government is lending, say it was lending to commercial banks at 9, and they have upped their lending rate to 10. Why don't we also, who are lending to government, adjust? As I mentioned earlier, there is usually an auction. When the government calls for an auction, it calls for papers. I mean, they call for tender to put in how much you are willing to lend at what cost, at what interest. So as I raised it earlier, there is always a free auction. Everyone comes with their money, and they say, government, you want a treasury bill, or you want to borrow for a period of, say, 6 months or 1 year, that is a 365 or 182-day paper. If your CBR rate is at 10, with me, I will also give you my rate, my money at this rate. So the rates, everyone is given a free will to quote where they are willing to lend government. But when they are lending, it's mostly commercial banks or primary dealers that come in. Even individuals bring in, but as I mentioned earlier, they do not quote. If you are below 200 million, you ride with the big boys. You don't quote the rate at which you are lending.
Yes, you're non-competitive.
Yeah, we call it non-competitive bidding. But the big boys who are really bringing billions to lend to government come in and name their price. So if you are giving them a CBR to be at 10, they'll also look at upping their rate at which they are willing to lend government. So I'll give an example. The last auction, T-bill auction, it came out at 15% for a T-bill 1 year, 15%, yet it has always been in the ranges of below 10.
Yes.
What brought that in the latest auction? It's because they also saw that if government, I mean, the Bank of Uganda has upped the CBR, we also change at the price at which we are willing to lend you. So in the auction, it so happens that everyone was quoting higher. So they usually come out with the average price of, say, if Stanbic is willing to lend at 16% and then Centenary at this rate. So they come out, after the auction, they come out with the average rate. And that average rate by consensus showed that the 1 year went up to 15% in the last auction. So to answer that question of what is the impact of the CBR on government paper. So that's why you see we saw the T-bill go up to 15%, the latest auction. The bonds, I think we had a bond which was a 20-year, which was at 18%, yet we were in the ranges of 15.
Yes.
So that has an impact on all other investments, but to cut it short, definitely when the CBR goes up, the yield will also have to go up. Yes.
Talking about the competition between these different investment options, you have the fixed deposits. Now you're seeing that the government is getting money at a very expensive rate. Also now the fixed deposits look a little bit more attractive. Where does it leave the other investment options? Because as of course we draw close to the last quarter of the year, people are now looking at where to put money, at least as we wind up there, so that they start strong in come next year, come 2023. So where does it put the other investment options that someone could actually consider, coming to the fact that now these other investments that we are seeing on the treasury bonds and bills are becoming more and more attractive.
Okay, thank you. First of all, we would look at what are the investment options that we have. The common ones in our market have been: 1, the shares or equities; 2, treasury bills or bonds; 3, we have the fixed deposits. That is when you put your money, instead of leaving it idle on your bank account, you agree with the bank that I'll lend you my money, usually for a period which you agree upon at an agreed rate of return. So someone fixing their money with the bank, we shall see the fixed deposits reducing and investors taking off their money to lend it to government because the rates are really lucrative. Also, when you look at other investment options, we have unit trusts, of which as SBG we have started one.
Already?
Yes.
Wow, that's good.
So someone who is not willing to look at these rates day in, day out, you know, someone has their money, they are not willing to look at where are the rates today, tomorrow, the other day. They may choose to invest in unit trusts aggressively. Reason: we have professional fund managers who look at where are the rates on a daily, and they keep investing, promising you a return. So to cut it short, we shall see more deposits leave bank accounts to go into the treasury bills and bonds, because really, if the fixed deposit side is at say 5-6% per year, and the bond is at 18% or 17.5%, of course, as any prudent investor, you choose to go for the high yielding investment. So that is one way we shall see. Really, as financial institutions, they have to be, especially the deposit taking, they have to be very innovative to keep the liquidity in-house. Otherwise, everyone would choose to lend to the biggest payer of interest, that is bonds and T-bills. 2, the unit trusts may get more interest from the masses. Why? The professional managers, once they see, usually when you are entering, they give you a rate. For example, I would say a money markets fund, which has been at 10 point something across, that is generally the industry average in unit trusts, may go up to 11 or 12. So these guys are managing it professionally, that they can even see it as the TB rate goes to say 15. They keep investing across the yield curve. So at the end, your return may also be increased if you are in a unit trust without any intervention of yours. Reason: the professional manager is looking at where the rates are, and they keep moving with investing for better returns over time. So, and currently they are still tax-free. I always mention it.
Yes.
So whatever you make as a return in a unit trust is tax-free currently. And usually, of course, as history has it, no one wants to pay taxes, much as it's our obligation, but everyone tries to mitigate how much tax they pay.
Yeah.
So to me, I'm seeing a shift from the traditional fixed deposits to 1, T-bills and bonds, and 2, into the unit trust, so those asset management units.
Let's talk about, before we wind up this segment, the diversification of our products here in Uganda. I've looked at the Nairobi market, the financial markets generally. They have different facets, like, for example, the exchange traded funds, very famous there.
Yes.
They have the derivatives, also very famous. Don't you think in times like this, like inflation and all these things that are bombarding the economy, we need a little bit of diversification, especially for our product types? Because even when you go to the United States, the people run to hedge funds, people run to ETFs in times like this for safety, because those other asset classes provide safety because of how they diversify your portfolio. Don't you think it's also high time for us to do a little bit of diversification?
Thank you for that. When you talk about diversification, first of all, it takes an enabling regulatory environment. Currently, in our regulations, the ETFs are, the rules and regulations are being developed. At least I've seen a paper with the regulators, the capital markets and the exchange. That may not be something that may come to fruit, at least this financial year, but that road is being taken. But as I speak now, I would comfortably tell you there are we don't have ETFs in our market.
Derivatives.
And derivatives, they are really not yet there because the regulations are still being set up. Also, we need an aggressive awareness campaign because currently we are still grappling with telling people what a share is,
Yes.
how you benefit from a share.
Yes.
I'll give you an example. This is it has on a certain show, and it really caught my eye. Someone said, I put in my money and you have paid me a dividend of 5,000 shillings. Mujog. I saw it. Really, it is because maybe that investor at the time of entry didn't get enough education on how do you gain more. Or when you gain meaningfully, the more you invest into the stock, the bigger the return. But someone who put in, say, 100,000 at an IPO, I think expected to double that. But a dividend which came on his phone really didn't go down well with him. So this is to try to tell you that we as market players still have a huge role to play in investor education. So the ETFs are an option, but unit trusts have become an easier option currently. Because our people have been used to circles. We used to have what we call this niginas, the bibinas. People would know that they are pulling money together for an investment or for a cause. People used to pull money for a party. Currently, are pulling money together for an investment, anticipating a return. So, in an unstable economic environment like we are in now, where everything is really on the run, unit trusts which have professional managers are the way to go. Yeah, thank you.
Yes, thank you very much, Mr. Musa. Now, we're going to take a quick breather, but when we return, we want to talk about shares. We've talked about the bond market and the money market, and we've seen that definitely in times of inflation, it could be a little bit safer. But how about the equity market? How do you deal with the bear market and still choose shares? Like you said, when there's blood on the streets, it's the best time to go out and get to pick shares. How do you pick them wisely and ensure a return in the future? Stay with us. You're watching SMART24 TV, and we drive your business.